There is a man I want you to think about. He is not famous in the way that traders on television are famous. He does not appear on magazine covers. He does not make bold predictions about the market on Monday and collect applause when he happens to be right. What he does is quieter, stranger, and far more valuable than any of that. He writes memos. He has been writing them since 1990. And in those memos, he has done something that almost nobody in the history of finance has done consistently across decades, through multiple crises, through bull markets that made lesser investors arrogant and bear markets that made lesser investors desperate. He has been right about the things that matter most, not because he is smarter than everyone else. He would be the first to tell you that. Not because he has access to better information. He would push back on that too. He has been right because he understands something about the nature of intelligence itself, specifically about the way that intelligence in the wrong hands or deployed in the wrong direction becomes a trap, a cage with gilded bars, a weapon pointed at its owner. Today, I want to examine something that has quietly destroyed more investment portfolios, more careers, and more long-term financial outcomes than any crash, any fraud, or any act of government policy in the history of markets. I want to talk about why the smartest people in any room so consistently underperform the ordinary people beside them. Not because they are unlucky, not because the system is rigged, because they are smart. Because intelligence deployed without wisdom produces outcomes that are systematically worse than the outcomes produced by honest mediocrity. And Howard Marks, perhaps more than any living figure in finance, has spent his life mapping this trap from the inside. Let us call this the intelligence trap. And let us begin by understanding exactly what it is and why you cannot see it until it has already closed around you. Stage one, the illusion of edges. When a highly intelligent person enters a complex system, and financial markets are, among other things, the most complex competitive system human beings have ever constructed, they arrive with a natural, reasonable, and almost always fatal assumption. They assume that their intelligence is an edge, that the same capacity for analysis, synthesis, and rapid pattern recognition that served them so well in school, in early career, in every domain they have encountered, will continue to serve them here. This assumption is not foolish. It is, in fact, the logical conclusion of a lifetime of evidence. Intelligent people have been rewarded for their intelligence in almost every context they have ever entered. Why would this one be different? Here is why it is different. In most domains, you are competing against problems. In markets, you are competing against other people, and not just other people in the abstract, but other people who have already processed the same information you have, drawn their own conclusions, and acted on those conclusions in a way that is permanently embedded in the current price of every asset. The price is not the question. The price is the accumulated answer of everyone who has ever thought carefully about the question. And when a brilliant analyst sits down to study a company, to model its cash flows, to read its filings, to understand its competitive position, what they almost always discover, if they are honest with themselves, is that the conclusions they reach are conclusions the market already reached some time ago. Marx has a name for this phenomenon. He calls it the problem of the consensus. And his observation is deceptively simple. In a market where intelligent, well-resourced participants are constantly processing information and acting on it, the consensus view is almost always already reflected in the price, which means that being right in the ordinary sense of the word is not enough. Being right about something that everyone else is also right about produces no advantage whatsoever. You are driving the same road at the same speed as everyone else and wondering why you are not arriving first. This is the first dimension of the intelligence trap. Smart people are very good at being right. Markets do not reward you for being right. Markets reward you for being right when others are wrong. And the very intelligence that makes you good at being right also makes you very good at convincing yourself that your correct sounding view is a contrarian one, when in fact, if you could hear what everyone else was thinking, you would find that your brilliant insight sounds exactly like theirs. Stage 2, second level silence. Marx introduced the concept of second level thinking in his first book, and I want to spend some time with it here, because I believe it is the single most important intellectual contribution any investor has made in the past 30 years. Not because it is complex, because it is devastatingly simple, and almost nobody actually practices it. First level thinking, as Marx describes it, is the kind of thinking that arrives at the obvious conclusion. The company is growing, therefore buy the stock. The economy is slowing, therefore sell equities. The interest rate is rising, therefore bonds will fall. These conclusions are not wrong in the way that factual errors are wrong. They are logically coherent. They follow from the evidence. And they are utterly useless to a serious investor because they are the conclusions that everyone who has looked at the same evidence has already arrived at and acted on before you finished your analysis. Second level thinking does not stop at the obvious conclusion. It asks a fundamentally different question. The question is not, is this good or bad? The question is this better or worse than what the market expects? Because in a world where prices already reflect the consensus view, the only thing that moves prices is surprise. The only thing that generates returns above the market is being right about something the market is currently wrong about. And to find those things, the places where the market's current answer diverges from the eventual truth, you have to think at a level most people never reach, not because they are not intelligent enough, but because it is deeply counterintuitive, profoundly uncomfortable, and systematically punished in the short term. Here is the discomfort at the core of second level thinking. If you arrive at a conclusion that is different from the consensus, if your analysis tells you that the obvious view is wrong, the immediate social and professional consequences are entirely negative. You look eccentric. You look wrong. You look in the most public and verifiable sense exactly like someone who should not be trusted with other people's money. Because the consensus is not just a price signal, it is a social signal. It is what your colleagues believe. It is what your clients expect. It is what the quarterly report will show. And when you diverge from it, you are not just taking a financial risk, you are taking a reputational risk. You are gambling with the most precious currency a professional investor has, the appearance of competence. This is where intelligent people fail in a particular consistent way. They understand second level thinking intellectually. They can describe it, they can teach it. But when the moment arrives, when their own analysis points to a contrarian conclusion that will make them look foolish for months or years before it is vindicated, their intelligence does not help them. It becomes an obstacle, because a truly intelligent person can always construct a narrative that reconciles their contrarian instinct with the consensus position. They can always find a reason why, actually, on reflection, the market might be right. They can rationalize their way back to safety, and they almost always do. Stage 3, the asymmetry you cannot feel. There is a piece of mathematics that every investor knows, and almost no investor actually incorporates into their behavior. It is this: if you lose 50% of your capital, you need a 100% gain to return to where you started. The path from 100 to 50 is a single bad decision. The path from 50 back to 100 is an extraordinary recovery. These two journeys are not symmetric. They never will be. And yet the human brain, even the brilliant, analytically trained, market-tested human brain, systematically underweights this asymmetry in the very moments when it matters most. Marx spent years writing about what he calls the perversity of risk. Not the existence of risk, which everyone acknowledges, but its perversity, the way it behaves, in the exact opposite of what common sense would suggest. Most investors believe that risk rises as conditions deteriorate. That when the economy is struggling, when companies are failing, when credit spreads are wide and prices are falling, risk is high. And they believe that when everything is going well, when spreads are tight, when defaults are low, when every deal gets funded and every quarter beats estimates, risk is low. This belief is intuitive. It is widely shared. And it is, as a guide to investment behavior, almost perfectly backwards. Risk is highest, Marx argues, precisely when it is most invisible, when lending standards are relaxed because defaults have been low for years, when leverage is abundant because volatility has been low for months, when every asset has been bid up because the economy has been growing for quarters. The tranquility of the surface does not indicate safety beneath it. It indicates that the conditions for catastrophe have been accumulating quietly without any visible signal in the gap between the price that optimism has produced and the value that reality will eventually enforce. Intelligent people understand this argument when it is presented abstractly. They can repeat it. They can explain it to others. But when they find themselves inside a period of genuine market tranquility, when their own portfolio is performing well, when every model is showing green, when the peers around them are celebrating, the argument loses its grip. It becomes theoretical, academic, the kind of thing you say at a conference but do not actually act on, because the cost of acting on it, of reducing risk in a rising market, of holding cash when everything is going up, of being defensive when offense is being rewarded, is immediate, visible, and painful. The benefit of acting on it is deferred, uncertain, and impossible to point to on a Bloomberg screen. This is not a failure of intelligence. It is a failure of temperament. And temperament cannot be purchased with IQ points. Stage 4, what the cycle teaches and why no one learns it. There is a fact about financial markets that is by now so thoroughly documented that it should require no argument. Every cycle in the history of markets has ended the same way. Excess optimism has been corrected by reality. Excess pessimism has been corrected by reality. The pendulum, to borrow Marx's favorite conceptual image, has never stopped at the midpoint. It has never reached equilibrium and stayed there. It swings from one extreme to the other, driven not by economic forces, but by human emotional forces, by the way that greed and fear, confidence and doubt, memory and recency bias combine in millions of minds simultaneously to produce collective behaviors that are simultaneously universal and unpredictable in their timing. Every intelligent investor knows this. Every one of them can point to the historical record. They can cite the tulip mania, the South Sea bubble, the railroad speculation of the 1840s, the 1929 crash, the savings and loan crisis, the dot-com collapse, the mortgage catastrophe. They know that cycles end. They know that excess is corrected. And yet, generation after generation, at the peak of every cycle, the same intelligent investors participate fully in the same excess, convinced that this particular moment is different, that the analysis that justifies current prices is sophisticated, rather than rationalizing that the new framework being used to value assets is genuinely new rather than the same old narrative in fresh clothing. The phrase Marx returns to most consistently across his memos is this: the most dangerous words in investing are, "This time is different." And he means this not as a dismissal of genuine structural change. He would be the first to acknowledge that the world does change, that paradigms do shift, that sometimes the old frameworks genuinely become obsolete. He means it as a warning about a specific failure mode, the tendency to reach for a "this time is different" argument precisely when the evidence for excess is strongest. Because the more obvious the excess, the more elaborate the rationalization required to remain fully invested in it. And the more elaborate the rationalization, the more intelligence is required to construct it. This is the trap in its purest form. The most dangerous investors at the peak of a bubble are not the unsophisticated ones who are simply following the crowd without thinking. The most dangerous investors are the sophisticated ones who have constructed an internally consistent, empirically grounded, intellectually rigorous case for why this time the prices are justified. They have done their homework, they have run the models, they have stress tested the assumptions, and they have arrived at a conclusion that happens to agree with what everyone else has concluded, not because they copied anyone, but because the incentive structure of the entire system is aligned toward that conclusion. Stage 5, the defense that intelligence cannot build. So what is the answer? If intelligence is the trap, is ignorance the solution? Marx would find this conclusion appalling, and rightly so. The answer is not less thinking. The answer is thinking about different things, specifically about the things that intelligence alone cannot provide. The first of these is what Marx calls the knowledge of where you are, not where you are going, not what will happen next quarter, not whether the Fed will raise rates or whether the election outcome will be bullish or bearish, but where you are in the cycle. What is the current temperature of the market? Not the economic temperature, but the emotional temperature. Are investors frightened or complacent? Are credit standards tight or loose? Are people borrowing because they must or because they are too confident not to? Are the deals being done because the economics are compelling or because there is too much capital chasing too few opportunities? These questions are not answerable through the kind of rigorous quantitative analysis that intelligence lends itself to. They require something different. Pattern recognition accumulated over decades of observation, the ability to read the room rather than the spreadsheet, the willingness to make a qualitative judgment about human behavior at a moment when everyone else is focused on economic data. They require, in short, the kind of wisdom that is orthogonal to intelligence, that develops not from being smart, but from being attentive over a very long time to the way that the same errors repeat themselves in different disguises. The second defense that intelligence cannot build is what I would call calibrated humility. Not false modesty, the kind of I could be wrong disclaimer that sophisticated investors append to their confident predictions in order to appear thoughtful. Genuine uncertainty about outcomes that are genuinely uncertain. The willingness to say, in the face of a market that is pricing in a particular future, that you do not know whether that future will arrive, and that your portfolio should reflect that uncertainty rather than obscure it. Marx has built his entire career on a specific version of this. He calls it the I don't know school of investing. It is not a school of passivity or randomness. It is a school of risk control, of constructing portfolios that can survive the scenarios you did not anticipate, rather than portfolios that are optimized for the scenario you expect. Because the scenario you expect is, by definition, the scenario the market is already pricing in. The value in your framework is not in the expected scenario. The value is in how your portfolio behaves in the scenarios that no one is pricing in, the ones that feel impossible today and inevitable in retrospect. The escape, what you can actually do. I want to be precise here, because vagueness on this question is its own form of failure. If the intelligence trap is real, if the very analytical capacity that drives smart investors to seek alpha also drives them toward the consensus, toward rationalization, toward participation in excess, what does an escape actually look like? It looks first like asking a different question. Not, is this a good investment, but what does this price imply about the future? And do I believe that implied future is more or less likely than the market currently believes? This question is harder to answer, requires more uncomfortable intellectual honesty, and produces conclusions that are often impossible to defend in a short-term performance context. It is also the only question that can generate returns above the market in a competitive, information-rich environment. It looks, second, like an explicit accounting of what can go wrong, not as a pro forma risk disclosure, but as a genuine, weighted assessment of the scenarios in which your analysis turns out to be incorrect. Most intelligent investors spend the majority of their analytical time building the bullish case and the minority on the bearish one. Marx has argued consistently for reversing that ratio. Spend more time on what can go wrong than on what can go right. Not because pessimism is virtuous, but because the downside of being wrong is mathematically almost always larger than the upside of being right. And intelligence does not protect you from that asymmetry unless you deliberately build that asymmetry into your process. It looks, third, like a kind of institutional honesty about the difference between analysis and prediction. Analysis can tell you about the current distribution of outcomes, the range of futures that are plausible given what you currently know. Prediction claims to tell you which future will actually arrive. Markets are full of prediction. Analysis is rare. And the confusion of the two, the mistake of treating a well-constructed analytical case as a prediction of what will happen, is one of the most consistent ways that intelligent investors destroy value. The investor who understands this does not stop analyzing. They analyze more carefully, with greater humility about the output. They understand that a 70% probability is not a certainty, that being right in 7 out of 10 instances still means being wrong in 3. And that if the 3 wrong instances involve the loss of 90% of capital, while the 7 right instances produce 15% returns, the expected value of their strategy is deeply negative. They think not just about being right, but about the cost of being wrong. Closing, let me bring these threads together, because separately they might seem like a list of cautionary tales, and I do not want to leave you with caution alone. Caution without a framework is just anxiety dressed in analytical clothing. The intelligence trap is real. It operates through the natural tendency of smart people to mistake analytical sophistication for investment edge. It deepens through the way that the consensus is assembled invisibly and collectively from the conclusions of precisely those smart people making their shared analysis the water they swim in rather than the edge they believe it to be. It closes around them at market peaks, when the most elaborate rationalizations are required and the most intelligent actors are most capable of constructing them. And it springs shut at the moment of maximum pain, when the same intelligence that constructed the bullish case is deployed to construct reasons not to sell. The escape route is not intelligence. It is the discipline to think at the second level when the first level is comfortable. It is the honesty to measure your views against what the market implies, not just against what your analysis says. It is the willingness to position for scenarios you cannot time, to hold reserves when the market rewards aggression, to be early and look wrong and remain positioned because the logic is sound even when the price is not. It is, at its foundation, a form of intellectual courage, the kind that does not announce itself, that does not generate applause in the short term, that looks for extended periods indistinguishable from stubborn error. Marx once wrote something I have never forgotten. He said that the riskiest thing in the world is the belief that there is no risk. He did not mean this as a clever paradox. He meant it as a description of a mechanism, the way that the absence of visible danger causes people to take on invisible danger until the invisible becomes visible all at once, in a manner that no amount of intelligence could have timed, but that any amount of wisdom could have anticipated. Here is the challenge I want to leave you with. Take the next investment decision you make, whatever it is, however small, and do not ask whether it is a good idea. Ask instead, what does the current price imply? And what would have to be true for that implication to be wrong? Sit with the discomfort of that question. Do not rush to an answer. The discomfort is the work. The discomfort is, in fact, where every useful insight in the history of investing has come from. The pendulum is always in motion. The only investors who ever made real money over real time were the ones who understood deeply where it was and had the patience and the nerve to position themselves for where it was going, not where it had been. That is the escape from the intelligence trap. Not knowing more, knowing differently. That's all. Thanks for watching.